Let's calculate the stock price for JPMorgan. First, we need a market cap 312.7 billion. And when I worked on Wall Street, this is one of the firms I worked at, JPMorgan. Now I live in California and do my own thing. Okay, so we figured out the shares outstanding. We take the market cap divided by the stock price. That gives us the shares outstanding, 3 billion. And what we're going to do today is we're going to figure out the value of JP Morgan. And the way to do that is you estimate the future free cash flows of a company, then discount that number back to today. Then you get a value for the entire firm. Now you take that value and divide it by the shares outstanding. Now you get the intrinsic stock price. And we're going to compare it to the actual stock price to see if it's trading higher or lower than intrinsic. Next, we need the free cash flow, which is in Google Finance, in the financial section under cash flow. And on the bottom, they list free cash flow. This is the cash that's left over after operating the business. Next, we need net income, and that's on the income statement. And last is revenue, which is also on the income statement. That's just total sales. Now that we have those numbers, let's take a quick glance. You can see there was a negative free cash flow one year. They might have invested in something that year, or they may have not had as much revenue that year. But it looks like revenue has been increasing steadily, so it wasn't a revenue issue. It's probably just some big expense. That's what happens with cash flow. It can be a little lumpy from year to year. If you have big expenses that are more one-time things like buying a building or buying equipment, and net income looks pretty steady. Now we need to look at the capital structure of JP Morgan to figure out the discount rate we need to apply to the future cash flows. So the interest they pay on the debt is $27 billion. And we need to look at the 10K for this. Actually, that's not the interest they pay on the debt. That includes some other numbers. So let's pull up the 10K. Okay, here it is. So this column is interest, and this column is balance. So they list short-term borrowings, so 1248 and 8807. So that's what the interest is. It goes 1248 plus 8807. So 10 million of interest. Now the short-term debt is 52,426. And the long-term debt is 247,968. So they have about 350 billion of debt, and they pay 3.35% interest. Interest payments are tax deductible, so let's get the effective tax rate. So the income before tax is 44 billion, and the income tax is 8 billion. So the effective tax rate is 18%, so the cost of the debt is 2.7%. And half of the capital structure is debt, which isn't such a great sign. You generally want to have less debt. And my new revised discount cash flow model takes into account debt as well and reduces the value based on the amount of debt a company has, which I think has been more appropriate than my previous model, which didn't take into account debt. So let's see the beta. It's 1.18. That's the volatility of the stock. So the way we calculate the cost of equity is we use a capital asset pricing model, and the cost of equity is 11.4%, and the cost of debt is 2.7%. And the reason equity is so much more expensive than debt is because equity is more riskier. In the event of a default, debt holders are paid before equity holders. And to calculate the weighted average cost of capital, we just combine the cost of equity, 11.4, the cost of debt, and we come up with a WACC, which is the discount rate we can apply to the future cash flows. And we calculated the future free cash flows for 4 years. Then we did a terminal value. And then we discounted those dollar amounts back to today, and we get a value of the company of $156 billion. And when we divide that by 3 billion shares, we get a stock price of $51. So it is trading at 102. So it's trading at 100% premium, double what the intrinsic value is. So let's look at the historical chart. And it looks like it was trading at intrinsic maybe a few years ago, but it's been trading at a premium. And stocks can always trade higher or lower than what they're really worth. It really depends on the demand of the market and what people are interested in paying for the stock. If more people buy the stock, it goes up in price, and if more people sell the stock, it goes down in price. So people have been bidding the price of the stock up. They just see more value in the future of JPMorgan than the present. So this is my model, and it's my analysis. So let me know what you think, and let me know if you want to look at other videos. Thanks for watching.